As always, it's my pleasure to have back with me today Charles Hugh Smith, well-followed, prolific writer on the web, who is the publisher of the website of2minds.com. Time once again, Charles, to exchange some ideas, which I always look forward to. Do you want to give a shout-out to our listeners on your latest book, Burnout, Reckoning, and Renewal? I have the cover up here on the screen now.
Yeah, thank you, Gordon. I've been trying to focus on practical solutions, both what I think are systemic and also just for our own individual and household lives. And so I think the pressures that we have often discussed here, economic and social, they have a cost quite often to us as individuals and as households. And one aspect of that or manifestation is burnout, that the pressures just become more than we can bear. And so we have to adjust our lives and our perspectives and our values in order to kind of get through the tumultuous period that we're all living in. And so this is my own personal story of how I've dealt with burnout. So I'm not claiming any expertise in burnout as a psychological or social phenomenon. I'm simply recounting my own experiences of dealing with it. And so I'm hoping that that offers some encouragement, if nothing else, to other people who are feeling burned out.
Charles, as I normally do, I need to stress with our new viewers that this is not an interview. We do these videos as a way of us productively dialoguing the important trends we're identifying and simply make our synthesis discussion available to the public for those that might be interested or want to contribute comments, which we truly welcome and value. I was recently thinking about our next video together, and I couldn't help but notice how much a number of subjects that Charles and I were writing about, how similar they were, yet coming at the same subjects quite differently. I thought it would be valuable to put them together and see if the synthesis abstracted some kind of hidden concepts that both of us were missing. To do this, we created the agenda that I'm showing here for our discussion today. And from the writings of this year's thesis paper in January, which we discussed with Charles and I in our last video, through to a couple of research videos I also released, I saw three themes that were really embedded. One was the reality that risk was going to have to be repriced. The fact that collateral that underpins credit was both seriously overvalued and in short supply. And three, there was an unavoidable problem that productivity must be increased from its declining trend in the developed nations, or our economic growth foundation was in, frankly, structural troubles. So as I mentioned, Charles's recent works were also bringing out these three themes as shown here. Almost immediate synthesis of this was that all three are connected by the fact they more or less follow a sequential waterfall. And as obvious as this is, neither of us was actually bringing this simple reality out in our writings. We were treating them as discrete items. We need to take this a step forward, which we are going to do in this session by briefly recapping our views on each subject and then seeing how that unfolds in terms of conclusions. As such, we would truly value your feedback in the YouTube video comments to further share what can be learned and what you learned from it. And as an aside, while you're there, please click the like button and subscribe button, as it helps offset the cost of producing these public videos. We have a lot of materials to cover, but before we do, Charles, any overall comments you'd like to make before you begin with the repricing of risk?
Gordon, I just want to mention to our new listeners and viewers that you and I have been discussing these the intersection of finance and the real world is how I would put it, for like over a decade. And so we do talk a lot about finance, but we also talk a lot about real world issues such as productivity, social change. And so this is where I think the waterfall, as you say, we didn't tie it all together. This is the intersection of a financial system which is not sustainable and the real world, which is facing real world problems that really have nothing to do with finance. In other words, productivity and various issues related to that. these are serious problems. Never mind what central bank policies, that can hinder it or help it. But, so there's real world issues and there's financial issues. And this is the waterfall because they are connected.
I have your repricing of risk up. We'll start there.
Okay. What I wanted to speak to in my work was, that there's a global, kind of change in risk. And and we've focused sort of exclusively in the moment on what central bank policy is happening at the moment, interest rates and quantitative easing, or what's the Bank of Japan doing. But we're sort of missing the larger picture, which is that, when the Soviet Union fell in, 1989, 1990, then that relieved the world of a lot of risk. And then, the globalization, the rise of China as the workshop of the world, the development of Southeast Asian economies. There were a lot of good things that happened, the internet in the 90s and the 2000s. And so the sort of global, risk premium had collapsed in many ways. And so, and we were also blessed with good weather, good harvests, abundant oil, and so on. So that's how interest rates could fall to near zero, was that there was just no risk premium. And so, now we're in an era where, the risk premium is much higher because of changes in geopolitics, in, scarcity of materials, and in, the unsustainability of our financial system. And so, this sort of virtuous cycle that ran from, like, say, the 1990s through the 2000s, it ended in the global financial crisis, when the unsustainability of credit, debt, and the financial system was revealed. And then we've sort of papered that over for the last 15 years. And in the meantime, there's even more risk now. And so that's why I concluded that there's no way that interest rates are going to sustainably drop back to zero. Yeah, they may briefly, but the price of money, of capital, has to reflect the global change in risk. And then therefore money is going to cost something going forward, because no one's going to accept zero or negative returns on capital that's at risk.
Couldn't disagree with any of the points, Charles, at all. They're right smack on. I came out of it with the same conclusions, but coming at it differently. And that is, my thesis paper this year, which is now available for public downloads at matasii.com, highlighted 3 findings. The Great Moderation, that I called it, or I've heard others also would call it, the Great Moderation has ended. We have entered a period of stagnation and stagflation, and risk will be repriced on 2 dimensions, both equity and debt. That was kind of the essence of what I came out of when I wrote it was about an 88-page thesis paper in January. The Great Moderation I'm showing here, which began in the early 80s, was a period of steadily falling interest rates from Fed Chairman Paul Volcker's nearly 19% Fed funds rate to, I'll say, Yellen's zero-bound quantitative easing. And financialization that drove those central banks' rates through the entire credit and lending industry were also making a huge shift in, as I said, credit and lending. And deflation, driven by globalization, with central banks unable to achieve their goal of 2%, was impacting this particular era. And a consequential rise in the mispricing of risk is what we saw. Risk actually was seriously and has been seriously mispriced for a long period of time, a few decades. And history told us, and our research convinced us, that the Great Moderation ended when inflation broke 5% on a sustained basis, when we went all the way back to the First World War. And it will no doubt fall below 5% at some point, but the damage has been done, and a disruptive shock wave is only now unfolding. And we'll likely experience, we're going to see through what we call the beta drought decade, economic stagnation and chronic stagflation that's shown here on this, also a similar waterfall chart of unfolding sequence of events. A consequential debt crisis at some point, and then an inevitable period of hyperinflation from poor reactive government policy choices. The result of this will be the same as you concluded, Charles, a repricing of risk. And we see it on two dimensions. Increasing equity premiums, the premiums that you have to pay for equity associated with the risk element, prices of debt, the risk premia for duration risk is also going to increase. So we're going to, as this chart shows, we're going to increase on both dimensions. That is the outcome of this whole period ending. This is going to happen. It's assured it's going to happen. The question is the degree, how quickly, and the duration. And we're seeing the prices of the bonds already up. We're not seeing it yet in the pricing of equities, but we're sure that it will unfold. Any comments on my comments, Charles?
No, I am glad that you posted this XY chart, because it shows how the shock waves are impacting the risk structure on multiple levels. In other words, this isn't just interest rates. There's a whole spectrum of risk that has to be repriced in equities, bonds, all assets, and the cost of money. And so this is I think this chart really exemplifies that.
The question is just how much this red chart is all going to move to the left and upwards in the movement. That's the question everybody's in the market are grappling with, specifically the bond traders. And it's going to happen, and inflation will come down, and then it'll surge. But as that unfolds, you'll find that the overall rates will steadily rise, even though maybe on the short term we will have a pivot and we will bring down forcefully in some version of quantitative easing the rates down. But it'll be like pushing pushing a damper that just keeps pushing back up. Whereas for years, what we've been doing is trying to raise inflation, the Federal Reserve and powers to be, and couldn't get it to 2%. It was just something we couldn't do. Suddenly, trying to get it down anywhere down to 2 to 3%, I don't think is going to happen. And I think that therefore the overall bond rates with the risk premiums are going to be elevated, and therefore debt's going to cost. Equities will have to reflect it too. And you'll see it in the high tech who've had a free use of money in many ways, and therefore we've been able to discount future valuations at a much higher level, and that is going to change. And with this comes profound change. And one of them that's already unfolding is the second point, Charles, that we have is the repricing or the revaluation of collateral, which underpins every piece of debt that's out there and underpins getting credit. And you want to take us through your points that you did in your writings on revaluing collateral?
Yeah, absolutely. As I say in my slide here, scrape away the complexity of every crisis and crash, and it boils down to the asymmetry between collateral and the debt secured by that collateral. And so I would look at the lens of every crash, going back, say, to the 1929 Great Depression crash. Very similar mechanisms are always at the foundation of this, and it's the asymmetry between the actual fundamental value of the collateral and the debt that's been piled on it. So if you look at the Great Depression, there was a huge expansion of credit based on like farmland, and at the time that the weather was good, then farmers would borrow huge amounts of money from the local banks, and they would buy more land, and they'd put it under the plow, and then the weather was good, and they'd make higher yields and so on. And in the stock market, you could borrow 90% with 10% down. In other words, your margin was not like 50% like now. It was like 90%. So you could buy $1,000 worth of stocks with $100 cash. And so, in other words, they were, the leverage on the collateral was extremely, asymmetric in that era. And then of course the whole thing collapses. And so, because assets are based on, the fundamental value, which is the income they generate as a general rule, right? The farmland is worth, based on the, income it can generate and so on. And the same with bonds and everything else. And I think that we also have to look at income is also a collateral. If I go take a personal loan at a bank, the collateral is not necessarily what I'm going to spend the money on. It's my income, and so you'll notice that I've often written about how the wage stagnation in the Great Moderation has been severe. In other words, the percentage of wages of the total economic value of the U.S. economy has been declining for like 40 years. And so the amount of collateral that can be assigned to income has been declining. And the only way that you can support credit when wages are losing value is you have to lower the interest rate, right? So that the person can qualify. And so now we've kind of run out of rope on that whole scheme where we can always we can keep expanding credit as income declines in purchasing value. And so that's kind of run out of rope. And so we're losing, we can't continue with negative interest rates in an era of inflation. And then in terms of collateral, I would like to speak real quickly to the last housing bubble, the subprime housing bubble of 2007-8 that brought down the entire global financial system. Remember how that worked, which was, somebody bought a house for $300,000. It quickly went up to $500,000. They mortgaged it for, $450,000, used $150,000 in free money to buy another house. And then they pyramided up these, the debt based on the bubble revaluing, the price of housing. But it was not really a fundamental revaluation. It was a speculative, revaluation based on basically fraudulent lending standards and all of that subprime. And I would argue that this sets up like a virtuous cycle. In the bubble, you can always borrow more because your assets just rose in value. And so it's such a great euphoric feeling on the way up, right? Because you can buy stocks on margin, and then stocks go up, then your margin account goes up, and you can buy more stocks, and you're making more money. And so that feedback loop is extremely powerful, and it's psychological as well as financial, right? You feel like you're a genius. So everything you're buying is going up in value, and you borrow more so you can buy more and make more money. And then of course that reverses, and then you get then the pyramid scheme collapses because the value of all that collateral was actually phantom. In other words, it wasn't really based on fundamentals of income. It was actually just an artifact of the bubble, which was an expansion of credit and leverage. And so as what's going to happen going forward as the current everything bubble inevitably meets its end, and collateral is repriced to the fundamentals. Well, the value of the collateral declines, then the credit that was extended on that is now underwater. And yet the debt remains. In other words, if the house falls in half from $1 million to $500,000, your $800,000 mortgage is still there. And so my chart from the Federal Reserve of the net worth of U.S. households, you can see that it's doubled since the global financial crisis. And so there's supposedly 162 trillion of collateral, which of course is so vast that you think, oh, well, the debt is just a minor part of that, But how much of that is phantom and how much is based on the fundamental increase in the income generated by assets? And of course, I would argue that based on fundamentals, I think this is like the most incredible bubble in history, or at least equals the South Seas bubble of like the 1700s.
Well said. Charles, I've often said that, wealth can only be created, and therefore wealth being collateral that you can post for securing more lending, is you either have to grow it, you have to mine it, or you have to produce it. You can't print it. And right now, the whole element of collateral has been repledged so many times with a process called rehypothecation, which means that the collateral is becoming posted by multiple financial institutions and is hard to track, or they're using concepts called collateral transformations to take marginal debt, almost the same as we did with collateralized loan obligations and collateralized debt obligations, which was at the core of the collapse in 2008 with the financial crisis associated with residential have just broadened dramatically in the last 10 to 12 years, but gets absolutely no visibility. So collateral is a very shaky thing right now, and it's in short supply. And you made a really important point that very few people really appreciate about collateral is that it's not just a house or a car or a business or some gold, something you can pledge that has value. It's actually jobs that people have which have working income coming in. Those job streams, income streams, earning streams are in many ways pledged now subtly as a form of collateral on loans, knowing that they'll have this kind of revenue or liquidity that's flowing, and there's elements that go with it. You know, the residential crisis that we saw in 2008, as I'm showing on this chart on revaluing collateral, we're now beginning and are already seeing collateral being revalued, and specifically in two examples is the current banking crisis that everybody I'm sure is quite aware of, and in what I'm calling CRE, which is commercial real estate and offices specifically. Both of those are changing quite dramatically. The banking crisis is associated with the values of the bank's treasury debt assets, currently showing over $600 billion in unrealized losses or devaluation. And this is the core asset that they're using and holding to base a lot of their loans on. You know, a loan, then it's an asset to them if they've bought it, but it's also an asset if they've lent it out in terms of unrealized loss or devaluation. The other part of it is unfolding shock in as I said, the office commercial real estate market with property devaluations, with it as used as collateral and multiple times over. And it's a different world with, it has the adjustable rate mortgages that was the big problem in the 2008. But in commercial real estate and offices specifically with the Zoom economy, people not wanting to work at offices, occupancy falling dramatically down to less than 50% right now in many, many cases, and taking down these prices, they also suffer from these mortgage rates are very short term. They're 2 and 3 years. They're always rolling them because of the size of them. So the refunding when there's a liquidity crisis going on just sets them up for almost guaranteed failure. They know it. They just haven't been expecting it to happen. This graphic really brought it home to me quite well, and it shows the commercial office real estate waterfall already underway. Just another this is a sub-waterfall. Which I highlighted in a video here just in the last couple of weeks called In Trouble, the New Big Short. And when COVID-19 lockdowns occurred, the IMF was so worried about the impact on global real estate, it issued a major warning as part of its regular financial stability report it was in April of 2021. And this schematic I'm showing here is part of it outlining the linkages of financial intermediaries involved in this process and in critical structural channels. And what is powerful here is conceptually there are 3 key channels through which a decline in commercial real estate prices interacts with other financial vulnerabilities to affect the financial stability. And the commercial real estate waterfall actually creates another waterfall, and these are the transmission channels that potentially feed and accelerate the instability and revaluation. And they're right here in the middle of the chart. The bank solvency channel, the collateral channel, and the non-bank financial institutions. And I could take you through, and I love to, but for the sake of time, it's just too much discussion. And I would refer you to the video that I put out in Trouble in the New Big Short, where we get into it in a lot more detail. But it's preordained. That's the point I'd like to make. Once it begins, it feeds on itself, and it feeds on each of these channels become drivers. And that's why the IMF so strongly warned about it. And this is before we had any problems. And now we're seeing them everywhere in the commercial real estate, specific to the office right now. And in some degrees, some of the retailers who are having problems, and in some other areas, the hotel and hospitality area. The rest of the areas seem to be relatively stable. But this is a big problem going forward in terms of revaluing collateral. Charles, any comments on that before we move on to discussing productivity?
Yeah, I just want to point out that, again, as you talk about income, it's also true of assets like real estate. and that if you have a large commercial real estate building and it's earning 100,000 in rent monthly, and then that rental income drops to 50,000, you can say whatever you want, but the value of your building just fell in half. And because that's the way it works, is that, the collateral is fundamentally based on the income generated by the asset. So what happens to the city tax rolls when a building that was worth $20 million is sold for $10 million? Well, your tax roll collapses. And so I just wanted to mention that too, that as you say, these lines of transmission for repricing risk and decline of collateral, they're going to impact not just one sector, but the entire economy and the social structure and the political structure. So I just wanted to point that out.
Today, the core of why it becomes almost unstoppable. We're grappling with, as it unfolds, is how serious we'll get, how pervasive it will get. And in the case of commercial real estate, it's a global problem. It's a round the world kind of issue. If you look at all of downtown New York, vast majority of the commercial real estate is owned out by non-American institutions and pension plans, insurance companies around the world, and in turn in their countries from assets and from American banks and American institutions. So when it spills, it's not a banking problem. It's not a commercial real estate problem. Suddenly it's an insurance problem because of how they make their money. Suddenly it's a pension plan and all forms of pensions who have got obligations. And it spills through the entire what we built is this financialization structure, all built on credit. Suddenly it's cracking here and cracking there. Does it suddenly and totally break down? I would argue not, that it would be quite similar to what we saw in 2008 between when we saw the problems initially with some of the loan operators, then triggered with Bear Stearns collapsing. But it was we were getting close to a year later before we got into Lehman and all the others, AIG starting to collapse. It took that long for it to unfold. And this was just in the United States. This is a global problem. We could be on this waterfall for a protracted period of time, just kind of a steady down, steady breaking, slipping, bad news, breaking. Of course, I could flip around. I don't mean to talk on both sides. It could suddenly collapse. We don't know. It's unknowable. So that's the point, though, of what you have to beware. It is going to happen. We just don't know the degree and the duration. Moving on to productivity, Charles, it sounds like they're disconnected from what's happening with repricing of risk and collateral, but they're not. Because the whole system, we're just talking about revenue streams and employment being central to establishing a lot of the collateral lines. A lot of it is based on labor force being able to work. And if it can't work, or if it can't increase its productivity, companies have to make decisions on reducing work. And one of the biggest crises is being pointed out by the recent Davos crowd in their survey is the fact that is a living wage, that no longer are the wages high enough to support the kind of standard of living in real disposable income because of inflation. And the rates, even though earnings may be going up, but they're not going up in real terms. And it's a serious problem. Do you want to make some comments on what you've seen with this ability to increase productivity?
Yeah, Gordon. And of course, we should do an entire program on it, but we're just going to kind of touch on some highlights. And what I've written a lot about the job market, and I wrote a book about it called Get a Job. And what I was writing about was how the economy has changed, in the nature of work has changed, and it's sort of gradual, so we may not really notice. And now, in all these geopolitical and financial changes we're discussing, I think that what needs to happen globally, and I think everyone's aware of this, is we have to rebuild our infrastructure, of energy and production, of industrial production. And so this goes by various names: reshoring, fringe shoring, and so on, and reindustrialization. And so this is going to require a lot of you could call it hands-on skills, but the hands-on skills in today's world require a lot of skills that relate to technology and computing and managing. So, in other words, when you're going to rebuild a refinery or an electrical infrastructure, there's a lot going on that has to be done in the real world. And I think that my point that I want to make today is that workforce is aging rapidly. In other words, the workforce that knows how to build, infrastructure skews to the older generations. And so I think there's a tremendous mismatch in the skills that we're training young people for and the skills we actually need. And so, for instance, there was a big push for over the last 20 years to teach young people programming, right? And so that's a useful skill, no doubt about it. Software is going to eat the world and so on. But software doesn't build a new electrical transmission tower. You have to actually have a factory that makes the steel and a certain kind of steel and cable, and then you have to ship it there, and then somebody has to pour the concrete and actually climb up and build the structure, right? So I think what we're seeing is our productivity is going to be seriously under stress as the older generation retires. And I have and there may not be young people that have the specific experience and training necessary to fill those same jobs. So you can see that here, and I know that I try not to do too much in the way of charts, but it's like here's employees, total full-time employees, and you can see that it's been stable for the last 20 years. It's about 100 million people. And then if you look at the 55 and older workforce, you see that it's gone up by 20 million people. That's the entire growth of the U.S. job market has come at of the older generation. So, there was like 15 million people, 55 and older, working to 20 years ago. Now there's 37 million. So as those people retire, I think we're we really have to re-engineer our workforce and to increase our productivity, because at this point, if you can't fill those high skill jobs that require a lot of experience, then you're actually going to see a decline in productivity, because systems break down when people don't have the skills necessary to keep complicated systems running. And the second chart just goes to show that the population is aging rapidly, and of course that puts another pressure on our total productivity, because we have to pay taxes to fund the pensions and Medicare for this fast expanding population of retired workers. So it's going to be a real challenge to integrate the skills that are needed and bring up the people that may be laid off because their skill set doesn't match what's required in an economy that has to reindustrialize and rebuild its infrastructure.
Charles, if we don't solve the problem on our ability in the developed world to increase, the world overall, to increase productivity, collateral values will fall, risk prices will go up, and here we go around that same loop again. These are major and difficult problems to solve. We looked at this in quite a bit of detail here 6 months ago. We looked at the present real problem with productivity within a framework going forward, and we see real pressures still in front of us in increasing productivity due to generational shifts in attitudes, expectations, and values. And this stems from the evolution to us of distinct differences in these factors between how different generations view things. Baby boomers, the Gen X, the millennials, and Gen Zs. And each of these are about 70 to 75 million population workforce-wise sectors. They're not insignificant, but they all have different views of, again, attitudes, expectations, and values. And these are generations that experienced unique impacts associated with the advent of the PC we take for granted, but it was a big deal to the Gen Xers and it changed their thinking. Then the internet, with the millennials, and then social media with them that didn't even exist. And now the Gen Zs and the Zoom technologies, and they're leaving indelible impacts on the workplace, which we just haven't got time here right now or this session to outline, but they're there and they're not being addressed. And there's a reaction and pushback coming it's showing up in labor shortages where people just don't want to take the jobs for various reasons, quiet quitting and all sorts of other things that we've discussed individually in some of our writings. And the result is they aren't going to stop this slide in U.S. productivity that I'm showing here. This is the U.S. It's a serious drop before these problems are really hitting. Nor on the world. I'm showing this is a global problem for all the developed world. And our research in this slide, which is from this year's thesis paper, shows that unemployment rates over the coming years, we believe, are going to surge dramatically to potentially north of 10%. And we're now at all-time low. It's a big surge that's coming. And it isn't just the advent of artificial intelligence technology development, which are significant, but they're still early, but they're moving at a phenomenal rate, which are about to explode on the scene. And Goldman's out saying it's about 300 million people that it thinks is going to be impact. I think that's a little dramatic, but I would argue it's going to be felt. No question about it. There's a mismatch in, as you're pointing out, Charles, in skills, education, for that matter. But as much about real disposable incomes no longer supporting current living standards and workers rebelling to this reality. And the groups, we can look at them differently. There's an unskilled segment, there's a semi-skilled segment, and then there's the highly skilled segment. It's not a matter of saying they're blue-collar workers. There's skills, and these skills are changing. You can have a PhD today and think you're a highly skilled worker, but that PhD can be obsolete in 6 or 7 years. Where are you? And it's the same with some of the semi-skilled in the trade, what we used to call the trades areas. And now they're demanding higher wages. So how does that flow through to our overall productivity? And they're distinct workplace segments that are going to require a dramatic shift in thinking and cultural expectations if they're going to be addressed, and with it, increase productivity of the whole available workplace, and not just those fortunate enough to be working. When we see this big surge in unemployment that our study concludes is definitely coming. Charles, conclusion, maybe wrap here what we've kind of concluded from. I have a couple charts here from that you thought summarized your thinking, and then I'll take you through a couple that I have of my conclusions.
Yeah, I just have two points I want to stress and kind of wrap up, Gordon. One is that there's a lot of chatter always about liquidity being the driver of asset bubbles, and as long as the central banks are creating liquidity, then that means that assets are going to go up no matter what happens. And a lot of people feel that this is like an iron law of the universe, basically like gravity. and it's certainly the last 15 years has provides evidence of that. But I go back to what former Fed Chair Alan Greenspan said in his mea culpa about how come he didn't anticipate the global financial crisis. And he basically said he did not anticipate the evaporation of liquidity in the marketplace. In other words, the central banks can do quantitative easing, and they can buy bonds and all the things that we say create liquidity. But in the marketplace, you have to have buyers who are willing to take the assets off the seller's hands. And there has to be if there's a mismatch there and people start becoming wary or cautious and they don't buy, then you have an evaporation of liquidity in the marketplace that causes a waterfall collapse in the value of assets. In other words, once people no longer believe that the asset's going to gain in value, then they become cautious about buying that. And so liquidity isn't just what central banks are doing; it's what happens in the marketplace, and that comes down to confidence and how much debt is being called. In other words, how many people are defaulting, how many margin calls are going out, and what's happening to the pool of buyers. And of course, I also mentioned that the trading algorithms, the trading bots, These are all trend following software. And so when the trend is unstable or it's declining, you're not going to have a bunch of trading bots buying, hundreds of billions of dollars worth of assets. They're going to stay out until the trend is established.
Charles, having lived through quite a number of financial crises or crises of different sorts, one of the things that I've learned is nothing disappears faster than liquidity. And it's like a thief in the night. It's gone. It always seems to be a shock to everybody why suddenly it's gone. And we have some pre-warnings, but when it happens, and it's driven by sentiment, it's not the banks, it's nobody reacting. It happens to them. And it's a lack of confidence. It just suddenly shifts. And you can see the confidence is already shifting quite significantly. And it's like a triggering event that I've seen consistently for 40 years.
Thank you for that excellent summary, Gordon. And my other point was about the revaluing of collateral, that if we look at collateral as based on the fundamentals of the income being generated from it, a lot of what we now look at as collateral is actually phantom capital. It's an artifact of a speculative bubble, not an actual rise in the fundamental valuation of the asset.
My conclusion from this is that the waterfall is inevitable. It is happening right now. The only questions you really have to be able to come to grips with that are unanswerable, so you have to pay attention as it happens, is the degree, the timing, and the fallout, and then react accordingly as you can see the whites of their eyes, if you would, as it unfolds. We're entering a new era that few have yet really grasped the full ramifications of. Everybody kind of talks about this is different. This is the post-moderation era, and it's different. It's different than anybody has seen in their lifetime. And it's like the 1929 stock market crash that was followed by the Great Depression. And it just changed a whole generation, their perceptions on value, habits, risk. It changed. Every 80 years we go through it. And we're in the middle of the fourth turning. And it's happening right in front of us. Now, how it'll unfold, we're getting some pretty strong clues. There are certain things that are inevitable, as I pointed out. But the future will go to the bold. And the followers who don't recognize what is happening will pay a huge price, a price that's both financial and personal. And that's why this is more than just about making money. This is central to life expectations for you, your family, your loved ones that you need to give a lot of thought to. Never mind your financial portfolio. And what's happening from my perspective too is, or rather, how it's changing my thinking. And what I'm seeing is being very important to me. It's showing in four things that I'm showing here. Mark to market. This is a concept that some of you may be familiar with. We got rid of in 2008, which actually reversed the financial crisis because we had banks with huge, and they have even larger, derivative structures today, and we stopped them. We allowed them to stop marking to market. They could market to whatever they had, because if that was to market, just like these current bank collateral assets in treasuries, the $600 billion that I referred to that are unrealized losses right now, they're not having to take. We never put mark to market back in, and it has profound implications when you realize the broad base which derivatives of all forms take, from inflation swaps to currency swaps through to normal stock options that you see with the pricing of derivatives is profound. And that's something that I think is springing from this, we have to watch, springing from risk repricing and collateral fallout, as we might get a collateral contagion. I'm looking at geoeconomics right now, where the control of pricing of risk and therefore credit is now about geoeconomics. It's not U.S. monetary policy centric like it has been during this last 40 years or longer, since the Second World War. This is a different world. We're moving from a unipolar world to a multipolar world, and therefore political economics and geopolitics and understanding them and what it means to a lot of these things we're talking about is more important than ever. They're not nice conversations, because they influence credit daily. And that gets to credit growth. The funding of credit will, to me, is going to have to change, and it's going to become increasingly, and this is what few people really appreciate about becoming more government guarantees. And so the government's not printing money through their central banks, but guaranteeing credit, not spending the money, guaranteeing it. That's called contingent liability accounting, which we've been doing for years, becoming much broader as the state becomes a bigger emphasis or a bigger controller of the economies of all countries. That's a shift that's going to impact these things we've been talking about today and your life. And then the last one, something, Charles, you and I have talked about before, here in America, we're a 70% consumption economy. And if the U.S. consumer retrenches for all the reasons we're talking about, even if it's forced to retrench and we see standards of living falling, we will see and should expect a reverse wealth effect. And that's out there. That's not hypothetical. That is a reality. And these are all there. They will unfold. The question is to what degree. Charles, that's kind of my thinking here at the point. Any last comments you want to make?
Yeah, I think that I'm glad you hit those points, Gordon. And I think my takeaway from your points are that the system is really unsustainable because all the tricks that have been played there's diminishing returns. And I put a chart in there of this so-called S curve where, we naturally keep doing the same thing that worked in the past, but we're blind to the fact it's no longer working effectively. It's actually creating problems. So instead of being a solution, it's actually the problem. And so every one of the points you mentioned is being presented by the status quo as a solution. And actually, it's actually a problem now that's exacerbating and pushing us over the waterfall.
Charles, I encourage all our listeners, if you've got any comments, and I'm sure you do, but views or suggestions or conclusions you're drawing from anything that we've said here today, please write them in the comments section so we can all share them and all learn from them. That's why we do these videos, to keep learning, so we can invest. Charles and I, can invest properly, and Charles Case improve his writings with more facts. Charles, you want to tell our listeners where they can get your work and see your writings?
Yeah, please visit me at of2minds.com. All the archives are free, and there's free chapters of all my books.
And please join me at Matasii, MATASII.com, for everything I've maybe mentioned here in the video and other things that we have available that we like to share. And again, just ask. We'll share them, but we just ask for your feedback if you've got the time and the patience to give it to us. Talk to you again in the near future.
Yep. Thank you, Gordon.
Thanks, Charles. Talk to you. Bye.